Hey, it's Stephen Kaufman with Zeus Mortgage and Zeus TV. We're talking about home equity loans again and home equity lines of credit. And we get the question, well, what's the difference between the two? We've spoken about in some of the other videos the big differences, like the fact that a home equity loan is limited to 80% of your home's equity, and a home equity line of credit is limited to 50% of the equity as a dollar amount. Well, but when would you want to use either one of those? Well, so let's talk about that. If you have single large purchases, you should consider getting a home equity loan. And in fact, most Americans, when they're pursuing getting a home equity loan, we call it a home equity loan because you're refinancing your current debt and your current equity, and you're taking out that equity and exchanging it for cash. So that's why it's still called a home equity loan. And by the way, we still call it a refinance, even if you don't owe anyone, because you have a home and you're getting new financing on that home, even if you paid cash for the home originally. So if you want to look at a home equity loan, which is what most Americans do, if you have single lump sum type purchases, like you're buying a new Harley, you're buying a new sports car, you're buying a boat, you're buying a vacation home, you're buying a second home, you're buying an investment property, you're paying for a wedding, paying for some college tuition, paying for that lifetime vacation, all of those type of expenses line up with a home equity loan because they're a lump sum, one time, and you can typically get more out of your home equity. You can borrow more against your home's equity in that type of loan. Now, a home equity line of credit is designed for reoccurring debt, things where you're trying to leverage things that are coming all the time, things like debt consolidation or home improvement type projects, things that are going to be happening over a long period of time. One of the risks, of course, of a home equity line of credit is that it typically comes with a variable interest rate, meaning the rate's not fixed and it can adjust, whereas you take a home equity loan, and once you close on that loan, whether it's a 30-year or a 15-year, whatever the term is, the rate's fixed for the life of that loan. And so there's a lot of security to be gotten out of that. Now, there are home equity lines of credit that do come with fixed rate options, but typically those fixed rate options are higher because you're paying for the flexibility of being able to take your money out $4,000 or $10,000 at a time. Okay, I'm Stephen Kaufman, and tune into another episode of Zeus TV where we will be talking a bit more about home equity loans, home equity lines of credit, and overall mortgage questions.